Words. Have you ever wondered what would happen if every bank in America suddenly shut its doors? Not tomorrow, not next week, but today. Imagine waking up on a Tuesday morning, your phone buzzing with notifications. You grab it, open your banking app, and instead of your balance, you see one message in bold red text: Service temporarily unavailable. You refresh once, twice. Nothing changes. You check Twitter, trending hashtags: bank shutdown, financial crisis, system offline. At first, it feels like a glitch. After all, banks have backups, right? But then the news anchors appear on TV, faces pale, voices tight. We are receiving reports of a nationwide banking system failure. ATMs, online transfers, and card payments are currently suspended. That's when it hits you. The world just changed. The panic begins within minutes. Every American city begins to feel it. In New York, lines start forming outside Chase and Citibank branches. In Los Angeles, people rush to gas stations hoping to fill their tanks before prices skyrocket. In small towns across Texas and Ohio, grocery stores can't process card payments. Cash becomes king again, instantly. But there's a problem. Most people don't carry enough of it. The average American has less than $100 in physical cash at home. Everything else, every cent, exists only as digital numbers inside the banking system. So when those systems go dark, money doesn't just disappear, it becomes trapped. And this raises a terrifying question. What does money even mean when no one can access it? The domino effect. Let's trace what happens next. First hour, panic. First day, chaos. First week, economic collapse. Banks in the United States aren't just places that hold your savings, they're the beating heart of the entire financial system. They connect businesses, investors, payroll systems, mortgage lenders, and the Federal Reserve itself. When they stop, everything stops. Your employer can't pay salaries because payroll systems rely on bank networks. Businesses can't pay suppliers. Stores can't restock inventory. And within 72 hours, America, the richest country on earth, would look uncomfortably fragile, the first signs of breakdown. By the second day, major cities would start running out of essentials. Gas stations can't process payments, pharmacies can't restock medicine. Truck drivers, who move 70% of America's goods, refuse to drive without guaranteed payments. In just 48 hours, the shelves at Walmart, Target, and Costco start to empty. And while officials go on air to reassure the public that everything will be fine, people remember one thing. The last time something like this even came close, the 2008 financial crisis, it took trillions of dollars in bailouts to prevent total collapse. But this time there's no bailout big enough, because this isn't a financial crash, it's a total shutdown. Meanwhile, on Wall Street, the stock market freezes. Without bank liquidity, the New York Stock Exchange halts trading. Investors can't sell or withdraw. The dollar's value begins to slide on global exchanges. Foreign markets panic, and nations holding U.S. reserves, China, Japan, Saudi Arabia, start scrambling to secure their own currencies. The Federal Reserve, headquartered in Washington, D.C., becomes the last line of defense. They issue emergency statements promising to restore the system. But here's the catch. Even the Fed relies on the very digital infrastructure now offline. So for the first time in modern history, the United States of America faces a terrifying truth. Money may exist, but access to it doesn't. The human response. By the third day, fear transforms into desperation. People who used to argue about politics now share one common goal: survival. Supermarkets start accepting only cash. But since cash is scarce, a barter system reappears. Gold jewelry, silver coins, cigarettes, even fuel all become currency again. The phrase liquidity crisis becomes literal. Meanwhile, ATMs sit idle, their screens blank, some are smashed open. Police departments report spikes in theft, looting, and vandalism. Not because people are evil, but because the financial lifeline of society has vanished overnight. For years, economists have warned that America's banking system is built on digital dependency. Every transaction, paycheck, and savings account relies on invisible code, an interconnected web that most people never see. And now that invisible web has snapped. A government in crisis. Inside the White House Situation Room, emergency meetings unfold. The President, Treasury Secretary, and Federal Reserve Chair gather to discuss one question: how do we bring the banks back online? The Department of Homeland Security suspects a massive cyber attack. Others fear a system failure, something internal. Whatever the cause, the U.S. economy is bleeding billions of dollars every hour. Without access to credit, the housing market freezes, auto sales stop, hospitals struggle to purchase supplies. The United States Treasury prepares emergency measures, printing billions in physical currency. But here's the twist: cash production can't match the digital economy. The total physical U.S. cash supply is only a tiny fraction, less than 10% of total money in circulation. That means even if every dollar bill was printed, it wouldn't be enough to replace the missing digital wealth. The realization. Somewhere around day 5, the truth becomes clear to everyone watching the news, scrolling social media, or standing in line outside a locked bank branch. Money, as we know it, is just trust. It's not the paper in your hand or the numbers in your app. It's a shared belief that value exists, backed by a system strong enough to preserve it. Without that trust, society starts to unravel. And yet this moment reveals something else, something most Americans never think about: how much power the banking system truly holds. Because while we think of banks as service providers, in reality, they're the gatekeepers of modern life. They decide when money moves, how it's stored, and who gets to access it. So when they go dark, the entire economy, from Wall Street to Main Street, goes blind. A glimpse into the past. It wouldn't be the first time America faced a banking shutdown. Back in 1933, during the Great Depression, President Franklin D. Roosevelt declared a bank holiday, closing every bank in the country for several days. The reason? Mass panic. People were pulling money faster than banks could handle. To stop the collapse, FDR literally shut the doors, froze withdrawals, and used that time to stabilize the system. When banks reopened, new laws were in place: deposit insurance, stricter regulation, and a promise that deposits up to a certain amount were safe. That law, the FDIC guarantee, still exists today. But here's the chilling part. If every bank in America failed at once, even the FDIC couldn't cover it. Why? Because the system was never designed for everyone to withdraw their money. The first week of the shutdown has passed, and America is no longer the same. Gas stations have gone dry, grocery stores are half empty, debit and credit cards, once the invisible key to daily life, have become useless pieces of plastic. The U.S. banking system, once the world's financial backbone, has gone silent. But now, a new phase begins, one that no one expected. The rise of a cash economy. By day 8, small towns and rural communities adapt faster than cities. People start creating handwritten ledgers to track who owes what. Churches and local stores become temporary financial centers, acting as hubs for trade, cash exchange, and barter. A gallon of gas might cost $25 in cash, or 2 cans of baby formula. In cities like New York and Los Angeles, however, chaos deepens, because when millions of people depend entirely on digital banking, even a few days offline feels like economic suffocation. Yet amid the panic, something interesting happens. Small groups begin using cryptocurrencies, Bitcoin, Ethereum, and stablecoins, to trade. For years, digital currencies were seen as risky, but now they're the only functioning money. People set up peer-to-peer transactions using phones and laptops connected to offline nodes. Crypto ATMs become black market hotspots. Suddenly, the same technology once mocked by Wall Street becomes the lifeboat of a drowning economy. The Federal Reserve's emergency plan. In Washington, the Federal Reserve announces an unprecedented measure: the creation of a digital emergency dollar, DED. It's a temporary digital currency controlled directly by the Fed, meant to restore national liquidity. They promise it's safe, encrypted, and backed by the full faith of the U.S. government. But there's a problem. To use it, citizens must register with the new federal digital wallet system, linking their social security number, ID, and biometric data. In other words, it's not just money, it's control. Millions of Americans hesitate. Some see it as salvation. Others call it the beginning of financial surveillance. On social media, debates rage. Is this the end of private banking? Will the Federal Reserve replace traditional banks forever? Is this the start of a central bank digital currency, CBDC, era? The political fallout. By week 2, the banking shutdown has turned into a national emergency. Congress holds round-the-clock hearings. Lawmakers blame each other. Some accuse regulators of ignoring cybersecurity warnings. Others suspect insider manipulation. Meanwhile, global trust in the U.S. dollar begins to falter. Foreign investors start selling US bonds, gold prices hit record highs, and nations like China and Russia quietly celebrate the chaos, calling it proof that America's financial empire is crumbling. For the first time in decades, the petrodollar system, which ties global oil trade to the US dollar, shows cracks. Oil producers begin experimenting with direct crypto payments and bilateral trade in local currencies. This single event, the US bank shutdown, ripples across the entire global financial system. Main Street reality. But while politicians argue, everyday Americans face a different war, one fought in grocery aisles and gas lines. A man in Ohio trades his old pickup for a generator. A nurse in Florida uses silver coins to buy groceries. A retired couple in Arizona sells jewelry for cash. For many, this crisis becomes a brutal wake-up call about financial dependence. They realize how much power sits in the hands of invisible systems, how wealth, savings, and stability can vanish with a single keystroke. You might think it's all dystopian fiction, but history tells another story. In Cyprus, 2013, banks froze withdrawals overnight. In Greece, 2015, people could only take 60 euros per day. And in Lebanon, 2019, the banking system collapsed completely, wiping out life savings and sparking nationwide protests. Now, imagine that, but multiplied by the entire US economy, the world's largest consumer market, the world's most powerful currency, and the world's most interconnected banking network suddenly offline. This isn't just a crisis, it's a reset. A shadow market emerges. By week 3, the official economy shrinks, but a shadow economy grows fast. Private payment networks appear, encrypted apps built by programmers and ex-bankers. Some Americans move to gold-backed digital tokens, others rely entirely on crypto. The government tries to regulate these systems, but enforcement is impossible. At the same time, criminal networks adapt too. Online scams, fraud, and black market trading skyrocket. The FBI reports a surge in ransomware and digital theft. With the entire banking grid unstable, cybercriminals find endless loopholes. The Department of Justice warns citizens not to trust unofficial payment systems. But by now, people are just trying to survive. Tasher, rebuilding trust. Then, around week 4, hope flickers. The Federal Reserve, working with major banks like JP Morgan, Wells Fargo, and Bank of America, manages to restore partial functionality to some systems. Direct deposits resume for government employees. Limited withdrawals reopen. But something's changed. Even as the banks come back online, Americans no longer trust them completely. People start keeping cash at home again. Others split savings across multiple institutions or even move to decentralized finance platforms, DeFi. Financial advisors report a massive surge in gold purchases, crypto investments, and wealth protection strategies. The fear of losing access once is enough to reshape a generation's mindset. Just like the Great Depression made people distrust Wall Street for decades, this banking blackout leaves a permanent scar. The new financial order. By the end of month 1, a new reality settles in. The US banking system is partially restored, but it doesn't look the same. Roughly 20% of small banks never reopen. The Federal Reserve digital dollar is now permanent, not temporary, and Americans are divided between convenience and privacy. Some love the instant transactions, the stability, and the government guarantee. Others see it as a form of digital control, where every purchase, every payment, every decision can be tracked. A few independent banks market themselves as privacy-first alternatives, promising old-school offline service. But most people adapt to the digital system because they have no choice. This is how the banking reset begins, not through conspiracy, but through necessity. Winners and losers. Every crisis creates both. The losers, traditional savers, small businesses without liquidity, and anyone who relied solely on digital cash. The winners, people who diversified early, those who held physical assets, gold, crypto, and emergency savings. Investors who saw the pattern used the chaos to buy undervalued assets. As markets reopened, they doubled or tripled their portfolios. Meanwhile, the tech companies behind blockchain, cybersecurity, and decentralized finance became the new Wall Street titans. And so, while some called it the end of the world, others saw it for what it really was, the birth of a new economy. The human story. Months later, when journalists look back, they won't just write about the Federal Reserve or Wall Street. They'll tell stories of ordinary people. The grocery clerk who started a neighborhood barter system, the programmer who created a peer-to-peer payment app from his basement, the family that learned how to survive on cash and community support. These people didn't just endure the collapse, they rebuilt from it. Because that's what Americans do when systems fail. They adapt, innovate, and rise again. Hash the new question. But here's the question that remains, one that haunts economists and world leaders alike. If the entire global financial system depends on digital trust, what happens next time that trust breaks again? Could the next shutdown be permanent? Will the Federal Reserve digital dollar eventually replace every bank account? Or could decentralized money, free from any government, become the true future of finance? The answers aren't clear, but one thing is certain. After this, money will never be the same. Closing hook. So if your bank shut down today, what would you do? Would you panic or would you be prepared? Because maybe the real lesson isn't about banks, systems, or policies. Maybe it's about understanding that in the end, control over your wealth starts with you.